Welcome to another episode here. We have, I'm Jamison Manwaring, and I'm CEO of Neighborhood Ventures. And we're excited to have a conversation today here with Connor Devereux with CoStar. But CoStar is more than just CoStar. You're wearing an apartments.com shirt. So it includes apartments.com, LoopNet,
correct,
homes.com. Mm-hmm. And so you're kind of covering the gamut there.
Yeah, big time. Yeah, so CoStar, it's oftentimes when I'm meeting people for the first time that aren't in the industry, and you're like, oh, what do you do for work? It's like, oh, I work at CoStar. And they're not in commercial real estate. They go, oh, what's that? And I go, well, okay, have you heard of apartments.com?
Yeah.
And they go, yeah, of course. It's like, well, then you have heard of CoStar. CoStar owns apartments.com, owns LoopNet, which is our platform for folks trying to buy and sell real estate. It's kind of our public-facing one. And then CoStar itself is sort of the back end. It's the backbone of what we do. And what is really driving that is a team of researchers that sit in Richmond, Virginia, and they are calling on every property across the United States, capturing information about their occupancy and rents, what are they seeing from leasing activity, and then also managing the pipeline, new projects coming under construction, and when we expect those to deliver, and then all of this sales and transaction information, getting buyers and sellers, pricing, cap rates, all that type of thing. And so, it's S&P 500 company, the world's largest, most comprehensive provider of commercial real estate data.
Yeah, and that's the back end is so critical when you're an operator, when you're looking to buy a building. The back end data that is very difficult to find if you're doing it as a one-off, and this is part of why CoStar was probably started in the beginning. We were very different from public markets where everything has to be filed, with the SEC in a certain time frame. We're in the private markets of real estate, but it's really critical to know what's happening in the market, what's happening with occupancy, what's happening with construction, if you're going to make a good investment decision. So excited as we have our conversation here to dig into how you aggregate that data, what are some of those key things, because it is very difficult to find on your own. And I think part of this, and this is definitely not a commercial for CoStar, but it's helping people understand, what tools are available to them to make better decisions. And really excited to dig into that. Before we do, can you tell us a little bit about your path to CoStar, and then a bit about what your role is today?
Sure, absolutely, yeah. So my name's Connor Devereux. I was born and raised here in Phoenix, Arizona. That doesn't seem like there are many Phoenix natives. It's something I'm very proud of.
No, you're in a small club.
Exactly. It's funny. The first time you talk to someone, you just ask them like, oh, where are you from? Because you assume they're not from Phoenix.
Right.
We've seen such strong population growth, and people continue to move here. So very proud of that fact. Went to high school here in Phoenix, and then University of Arizona in Tucson. Studied business, and my heart was in economics as my major. And then came back to Phoenix, started working at Marcus and Millichap in the research services team there. Did that for about 7 years in various roles, and then made the jump to CoStar a little over 3 years ago. And that movement to CoStar was a really exciting opportunity for me because it was focused just on Arizona and Phoenix. And so I'm part of the CoStar market analytics team, which is basically a small group, maybe 30 to 40 of us across the country. Each has their own geography. And all I'm doing all day is looking at the numbers that CoStar collects through the research apparatus that we talked about, and apartments.com obviously has deep penetration into the multifamily world. And so I try and take all of that data and those numbers, combine it with some economic information, population growth, job growth, and then form a narrative about what's going on in the Phoenix apartment world, or real estate, or retail, or office, industrial. Those are the 4 property types I cover. And what's been great about it is you really get the opportunity to go deep. Previously, I was sort of touching many markets, but couldn't go as deep. Now that I can really sink my teeth into Phoenix, a place that I'm very proud to be from and love. I feel like a greater connection to where I'm from too. And so it's been a great opportunity, and I'm really happy to be telling that story.
Yeah, that's very interesting insight, because real estate is one of those things that, especially the commercial real estate side, that there are so many transactions happening across the U.S. at any given time that you either kind of become a high-level generalist across geographies, and that can give you some insight, a kind of a macro insight into bigger trends. But at the end of the day, what's happening in multifamily in Phoenix is very different today than what's happening in New York City.
Big time.
Or Chicago, or Austin, or Tampa,
San
Francisco, or Seattle.
Yeah.
Each geography has its own dynamics, which is part of what makes real estate so fun.
And you got to go, it's not just the market either. I mean, Phoenix is so broad. I describe it as a bunch of cities that are growing into each other. And so it's submarkets, it's micro markets, neighborhoods, cross streets. Like, you got to know what are my demand drivers in my immediate area around my property to fully appreciate, how that asset may perform.
No, it's a great point. For us, in the company we're building, we've focused on multifamily, and we've been in Phoenix, and then we have a secondary market in Flagstaff because we really like both of those markets long term. And there are groups who decide they want to buy multifamily across the country. So they might buy 10 buildings in 10 different markets. And then you have other operators that say, we're going to own 10,000 or 15,000 units in one market, or even more. And so that's kind of the big decision you have to make as an investor, as an operator, is where do we want to go? Do we want to try to diversify across geographies? Do we want to diversify across different asset types? It's so dynamic. So love the fact that you're from Arizona, and you have the roots here, and then you're also completely, vertically integrated across those sectors in really understanding the nuances of Arizona. Maybe to start out, could you give us a little bit of an overview of those different sectors from a high level, how they are performing in the Phoenix MSA, just to give people a flavor of how dynamic it is even across those four things in Phoenix?
Absolutely happy to do it. The quick elevator pitch, if we'll call it, for each property type. I'll start with multifamily. That's one I think folks are probably most interested in.
That's the one I like the best.
That's the one you like the best. So Phoenix Apartments has been navigating a period of operational disruption for the better part of 3 years now. That's almost entirely supply driven. We saw the most new construction since the 1980s enter our market, and the increased competition from new supply has hampered occupancy and turned rent growth negative. And then most recently in 2025, there was some optimism, I think, in 2024 heading into 2025 that I don't think anyone was expecting it to be a good year, but I think they were expecting it to be less bad than 2024. And 2025 has underperformed even those low standards. It's a tough market right now. I talk to property managers, brokers, investors, and it's tough out there. And it's mostly due to the new construction, because from a demand side, in terms of the number of units that are being occupied, it's healthy, it's strong, but the new construction continues to overpower that. And I want to keep going with this, but when you say it's tough, we're still over 90% occupied across the board. Correct? Yeah. So we see stabilized vacancy at about 8.5%, pushing 9%. So that would be about 91% occupancy. The newly built properties in lease up have a much different, higher vacancy, and lease up timelines have extended. You often have to offer very generous concessions to get community or renters into your community. But yeah, so it's still 91% occupancy.
And those concessions kind of have a ripple effect across everyone, because residents who might be happy where they're at, they see that the grass is greener on the other side because they're going to get 2 free months of rent. And if you amortize that over a 12-month period, the rent is pretty low. So yeah, that's an important distinction. So we're about 91% occupied for stabilized properties.
Correct.
What are we seeing? You mentioned that the lease up is extending on new properties. What else are we seeing with new properties, with absorption and with occupancy there?
Sure. So we've seen that absorption at new communities, or new communities dominate or comprise the bulk of the net absorption. So we had something like, call it 17,500 units of net absorption in the trailing 12-month period through the third quarter, which is a lot. Pre-COVID, we were seeing about 7 to 7.5 per year.
So we're a lot of demand.
A lot of demand. The problem here is, of course, that new supply is even stronger. We had something like 26,000 deliveries in 2024. 2025 is looking to be another heavy year for completion. So demand's strong, supply is even stronger. And this is actually one of the big misconceptions that when I'm talking to folks that they have trouble squaring, which is, how are you going to tell me that apartment demand is strong in Phoenix when my property is occupancy is falling and my rent growth is in negative territory? I've had to ramp up concessions. And so I have to back up and do a better job of communicating that I'm talking about aggregate market-wide demand. And what I should be saying is that aggregate market-wide demand in Phoenix is strong, but is still being overwhelmed by supply because we're adding more units. And so that demand is being spread across a broader number of properties. And so at the individual asset level, oftentimes they're seeing demand moving backwards. So from rent growth in negative territory, I think we tracked the third quarter about negative 3% asking annual rent growth. You add on concessions, it gets worse. Last year, 2024, we ended the year at about negative 1.5 to negative 2. The year before that, about negative 1.5. So
it's not falling off a cliff like some people might expect. We're seeing 3% down year on year. That's a lot for apartments, right? Historically.
Yes.
And that's off of 1% down last year, 1% down the year before. But we did see big increases during COVID.
Correct.
High teens, low 20s increases in rents. So we're in a cyclical business, so there's going to be some rebalancing of that, and I'm adding my commentary into what you're seeing. For most of us in the industry, we're not surprised by what we're seeing because I think Phoenix is oversupplied in the short term. So let's look at that a little bit. How long do you think this lasts? And we have really good visibility into the construction pipeline, new supply coming on. That's not something we guess at because that's a two-year time frame on the outlook because we know what's coming down the pipeline. So how does it look to you for when things turn around? Yeah,
so we're seeing that new deliveries are peaking like now, basically. Depending on what data provider you use, CoStar had it technically peaking in the end of 2024, and that there's going to be a modest pullback in new supply in 2025. Still a lot. If we were at 26K last year, it looks like we're trending closer to 22K for 2025. Next year, we're seeing another step down, bigger step down. And then 2027, but it's not enough, in my opinion, to really cause next year to be approached with a lot of optimism. I think the general sentiment is, gear up, could be another tough year. I don't expect there to be positive rent growth. You might be able to push at the margins at renewal, maybe burn off some concession, generate revenue that way. But in terms of market-wide asking rent growth, our
2026, isn't it?
And then looking to 2027, that's where I think you could start to see, I think 2026 will be the full bottom, 2027 start of recovery, and then moving on to 2028, well, that's when we'll start to really see things pick back up. The challenge becomes, what does the supply picture look like in 28, 29, 30? And now I know we're talking 5 years out, but there's been some talk that developers are even starting to put some units in the pipeline, out that far, because people like the fundamentals in Phoenix.
Right.
I mean, if we just go back to the underlying drivers of commercial real estate demand and multifamily, population growth, check. We are a strong population growth market. You look at job growth and economic diversity, we're outperforming there too. We have a great regulatory environment, business friendly, low tax. All of these, weather. We're sitting here in October. It is beautiful out, and it's only going to get nicer compared to some of these other places. That attracts folks to be here, and so all of that is supporting.
We don't have hurricanes. We don't have tornadoes. We don't have. We do have some monsoons, haboobs.
We do,
but we all actually like those.
Yeah, I do.
And to your point, I just came from a conference, Zillow conference in Austin, and the property managers in Austin are at wit's end because they got a ton of supply, like we have, but they haven't been able to absorb it.
Yeah.
So we are taking this on the chin pretty well as a market. With all the new supply, and we're number one in the last 2-3 years, and you can throw Austin and Dallas and a few other markets in there too that are near the top. Dallas has absorbed pretty well. Austin has not. So they're seeing pretty dramatic price decreases in rent, a lot of occupancy. I talked to one property manager who has a property in Florida, which is in a Jacksonville market that also had a lot of supply and not a lot of demand, and they're 25% occupied. And this is a group that knows what they're doing. They have 10,000 units there, and the building is just there's not enough demand there. So from Phoenix standpoint, given the conditions that it had with all the new supply, it's done well. And I think it's important, as you talked about the pipeline, when we look out at the big developers. They do believe in Phoenix long term. They are going to continue to build here, but I think where we see demand, where we see supply come down, is more of the speculative, shorter term groups that usually are build a majority of the apartment units that won't be able to get the financing. They won't be able to have so aggressive underwriting, and we'll see how that plays out into this next round of new construction. But I think there'll be a lot less of those groups. You'll still have the big groups, the REITs, that just say that's a market we're going to go in and we build, and we're in it for the long haul.
I think it comes down to the capital structure and like how you capitalize these projects. I think what I've been hearing is equity for new construction, multifamily in Phoenix is tough.
Yeah.
So that's the thing is, I think that's going to be the rein on new supply for our market, and trying to get, maybe the developer wants to move forward, but raising the equity to go actually do so is a challenge. And so that'll pull back. But the folks that have their, either that's like internal capital that they can go spend, some of those folks maybe can continue. But either way, you look at public permit issuance data, it's pulling back.
Yep.
Our, CoStar's construction starts numbers have fallen. We are seeing a pullback in deliveries in 2026 and then again into 2027.
Yep. And
then beyond, it sort of remains to be seen. But I don't expect we'll see anything like we've seen in the last couple of years.
In 23 and 20, even 24, the phrase was just survive till 25. And now they're saying things will be great in 28. So the reality is, though,
with their rhymes.
Our buildings are full. We do our property management in-house. We have to be responsive. We have to hustle. We have to do the right things to keep our properties full, but they are. And we're leasing up a couple of projects too, and they're not new builds, but they're renovation projects or adaptive reuse projects, and we're seeing progress on those. So you can still survive, and we're in the down part of this cycle because we're oversupplied. So from our standpoint, we're glad we're here because we can get through it. Now, I want to spend all day talking to you about this stuff, about multifamily, but we need to, let's hit those other sectors.
Oh, sure.
From a high level in what we're seeing in Phoenix. So maybe we jump into industrial, which is kind of the other highly desirable, hot commercial real estate investment over the past few years and where we're at there.
Yeah, sure. So I think that's a natural segue from multifamily to industrial, because facing some similar dynamics just in the terms of the amount of new construction that was delivered over the last couple of years in the Phoenix industrial market, it's pretty staggering. If you just look at it on a chart, it's tens of millions of square feet, much of which was built on spec, meaning no tenant in place, and a lot of that delivered vacant, caused our vacancy rates to spike. But again, if you look at the demand side, there's a lot of really powerful tailwinds supporting the Phoenix industrial market. Our location near Southern California, SoCal ports of entry, goods flow from LA and Long Beach east along the I-10 to the West Valley of Phoenix. That Loop 303 corridor has been completely turned over. There's tons of brand new, really nice industrial product, and the Amazons of the world are going in and snapping it up. But there has been a lot of new supply, and industrial is interesting in the sense that the temperature is much different depending on the pool that you're swimming in. So I mean that in terms of size. So especially there's a kind of a barbell situation going on where the small bay stuff, call it under 75,000 square feet in terms of the building, availability is much tighter. And then when you go really big, 700K, 800K plus, it tightens up again too. You talk to brokers out there who lease, that big bomber stuff. They say, hey, by early 2026, we're going to be out of million square footers. That paper's trading on many of them. It's that sort of middle 100 to 250, 300K space where new construction was very aggressive. That's where it's a lot of pressure. And then there's also dynamics East versus West Valley that we don't need to get into, but the West Valley is generally outperforming compared to the Mesa Gateway Airport area, which is seeing empty units accumulate more quickly.
And what does the pipeline look like for industrial? Has that slowed down as well?
Big time. Yeah, we saw a meaningful pullback in new construction. Tens of thousands of units were delivering of square footage was delivering per quarter, and that's now coming down meaningfully, and maybe start to see it perk up again depending on where you are. But for the most part, the supply wave is over, and now we just need to digest what was delivered.
Yeah,
similar to what the multifamily world is seeing.
So strong demand.
Yes.
One of the big differences between multifamily is to rent one apartment might be $1,500 a month. To rent one, even 7,500 square feet in industrial, which is on the small side, that's a pretty big lease to sign. So lease up is a whole different ball game. But I think the barbell impact is interesting. There is something consistent about that. That at the low side and at the high side do well, but the mushy middle has a hard time, and it's interesting that's how that's playing out. We want to touch on retail. We actually own one retail property as well, so interested in your thoughts there. The retail's had a lot of headwinds with online migration. But that's not new. That's been 20 plus years of a trend, and now in some ways retail is kind of booming back depending on how it's done. But what do you see in Phoenix?
Yeah, big time. I describe retail as quietly outperforming. Retail, if you look at just the raw numbers, vacancy at one of the lowest levels we've ever seen. The compression in vacancy from pre-COVID to now is one of the largest improvements across the major markets in the U.S., Phoenix's performance. Rent growth remains in positive territory. We saw extremely strong rent growth 2023 through 2024. It's starting to come back down to earth, but still healthy, one of the strongest in the country. And the reason for that is that we have basically structurally underbuilt the retail market over the last, call it, decade to 15 years. Phoenix especially was hit incredibly hard during the Great Recession back in 07, 08, where we were building a lot of new retail into a downturn. And so then that caused development for new retail product to really remain low for over a decade. And so now we're starting to see dynamics where if you're a tenant out there looking for space, it's hard to find really quality options.
Yep.
Availability is really compressed, and they're starting to see some retail construction pick up, but nowhere near what we were seeing pre-COVID, pre-Great Recession. And so I think from a fundamental standpoint, just pure Econ 101 supply and demand, we aren't building enough. And then on the demand side, the consumer in general is still feeling pretty healthy, depending on what numbers you look at. But, personal consumption expenditures, inflation adjusted is still in positive territory. It's very fascinating in terms of you look at the sentiment surveys, and you ask consumers how they're doing, and they're down in the dumps. Consumer sentiment is very poor. But when you look at what they actually do, folks are continuing to pull out the credit card, and that's supporting underlying retail space demand. So retail doing very well. And I think one of the nuances that we've seen for retail is that because of the lease structure, 5 to 7 year leases are typical. If you have a lease coming due now that was executed 5 years ago, the amount of rent growth that has occurred in that time, the market rate, you have a meaningful leasing spread between contract rent and what is market rate. And so there's a lot of embedded rent growth in a lot of these properties that is really attractive for investors.
It just kind of unlocks over time as those leases come up.
Yes, exactly.
Fundamentally, that's where you want to be, is a supply constrained market. As you drive around town, there's very few, good retail places that are not full or have, great tenants, and especially as you are looking for restaurants, you're looking for drive-throughs, those are in such demand. We will most likely see some more pharmacy as Walgreens and CVS go through their restructuring, like we saw with Rite Aids. So we'll see. There could be some opportunities there. But we have a property in Tempe, and it has 2 drive-throughs. Now, getting those approved through the city took a long time, but post-COVID, people don't really want to go into the restaurant, but they're ordering out more than ever. So going through a drive-through, obviously DoorDash, but restaurants now are able to augment their revenue with some of those delivery services and have a very profitable business. So let's move into our last big commercial real estate sector is office. And I had a conversation with a developer in Chicago. The office situation in Chicago is way different than what we have in Phoenix because there's such a large footprint of office in Chicago. And one of the big headlines of this last week was a very large developer launching I believe it was a $10 billion fund for office to housing conversions across the country. So what are we seeing in office in Phoenix? And then maybe you could talk to us about some of the hot areas for office and some of the slower areas.
Sure, yeah. So if I described retail as quietly outperforming, office would probably be loudly underperforming. Maybe too loud, depends. I mean, it's definitely facing some challenges. I think Phoenix is better positioned than other markets. We didn't see the same amount of over-leveraging in terms of pricing going really high. Like our most expensive Class A deal topped out somewhere around like $550 to $575 per square foot on sale. You compare that to some other markets where it's well beyond that. So the correction in some of those areas was more severe. Phoenix didn't see that same level of run-up, so it's more comparatively well-positioned. But what we have seen is that demand is finally firming up. If you look at traditional office, so stripping out owner-occupied and smaller properties in medical, just normal run-of-the-mill office, vacancy had been moving up consistently. We were flirting with something like 23% vacancy, and that was because we were seeing negative 500,000 to negative 1 million square feet of net absorption per quarter. Demand, more people are moving out of offices than occupying them. And for the last 4 quarters now, we have seen 4 quarters in a row of flat-ish to positive demand, which has allowed this vacancy rate to finally peak out and move sideways. If not, depending if you squint, it looks like it's starting to head down. So it looks like that the worst is behind us and that we're starting this new growth cycle. A lot of that reason was we had owner-occupiers, so tenants go out in the market like a U-Haul, who go in and take down a heavily vacant office building. They can buy it for $80 to $60 a square foot, and then use that for their own footprint needs, that takes a big chunk of space off the market.
Yeah, and I saw that deal there on Thomas in Central.
Yes.
Actually, near where I live. I think it's at one point it was the largest tower in Phoenix, and we saw it came up for sale. I believe they ended up buying it for $20 million for, that's probably 20% of the replacement cost.
Right.
And of course, U-Haul, this is great business that's based in Phoenix. They never sell any of their well-located assets, and of course they come in and buy it and relocating in there. Great move by them, but to your point, that is more common in Phoenix because there's not that much available that comes up.
Yeah, so that you see these, and there's other examples of folks who are doing this, buying heavily vacant office buildings and then just taking that off stock. The other area we're seeing it is, I know you'd mentioned conversions. Office to resi in Phoenix, it doesn't seem like it's going to be a major trend. We just don't have as many of the pre-World War II office buildings that make good conversion candidates.
Yep.
As being a younger, newer market. But what we have seen is conversion or reposition. So buy a commodity B- office building in a location that's not super strong, and it's maybe not an attractive location for an office building, but it's a great location for an infill industrial building. And so we've seen several groups go out, buy these buildings for, call it $100 to $115 a square foot or less, demolish and then build infill industrial. Same kind of play with office, traditional office to medical office, where you can take a building that's underperforming, use some vision and reposition and put it into a place where demand is strong. And that's been one thing that's helped, take some of these older obsolete buildings off the market. Also, we've just seen, tenants are expanding. The challenge is some are expanding and growing their footprint. Others and many are still, because of the lease structure, 5-year, 7-year leases. Some of these got extended for a couple of years, that when they're finally up and need to make a long-term space decision, many are choosing to downsize their footprint or right size. People have gotten more efficient with their space. And oftentimes what you're seeing is people choosing to upgrade the quality of their building but lower their footprint to maintain a similar real estate cost. So you'll see people moving from maybe Midtown and downtown Phoenix, which were areas that are more struggling, into the Camelback Corridor, into some of these really nice buildings. So the office market, I describe it as one that you cannot paint with a broad brush. There's tremendous differences depending on what segment of the market you're in. And these really high quality, I call them prime, you can call them trophy, alpha, these like ultra nice double class A trophy assets are doing pretty well. And rents continue to push up there. We smashed through the $60 a square foot barrier, which is, you look 5 to 7 years ago, that was kind of unthinkable. And these buildings are continuing to invest in their space. Tenants want the best stuff in the best location with the best amenities, and they're willing to pay for it.
It's kind of like the haves and have-nots. The really nice Class A is doing very well, and at the other side, the buildings that haven't had updates, that feel like you're working in a dungeon. Nobody wants to be in there, and no one wants to go back to the office if that's where the office there are to go to. I do think 2026 is where we'll see the kind of the smoothing out of the back to the office, where it will be kind of figured out as a lot of larger leaders in the space have said, hey, you got to be back at the office 3 days a week, 4 days a week. And I think that will kind of 2026 is the year that gets figured out. So we kind of know where where that will sit, and then from there we figure out how will people grow, how will the people expand their footprint. And I think it's a little early for me to from the office standpoint, but I do think there's going to be an opportunity here at some point in the next few years because I think people are realizing they do want to go to the office. It might not be, 70, 80 hours a week like I did when I lived in New York. I wish I didn't have to do it back then, but it might be 3-4 days a week, and they want to go to a place. They want to go to a nice place to collaborate. Yeah, great insights. Just as we finish up here, the offering that CoStar has you, because you do a lot of different things, but if you're a real estate investor or operator, to get access to the back-end data, is there a suite for us available for a more small boutique office? Now, so if you compare this to like the Bloomberg terminal, so the Bloomberg terminal costs about $30,000, higher than that now, it's probably $40,000 per computer. And I had when I was in New York, and the company would pay for that terminal $30,000 per person. So only the very high-end large firms were able to afford a Bloomberg terminal for their analysts. But for CoStar, is there an entry-level product do you think is kind of available to anyone, or is it kind of more for just the big firms?
No, so I think there are, I would need to connect you with one of our sales professionals who could, size up any type of subscription for folks. But there are tons of users who are not Blackstone that use CoStar and get a lot of value out of it. Feel free to reach out to me or contact your local CoStar rep. There's a Phoenix office here. They'd happily talk to you about what the product can offer and how what pricing would.
So it's not just for the big dogs. No. It's and a lot of the big firms do a lot of that research themselves too. So, but.
Developers, owners, the high net worth individual with a small family office or a team that around him or her, they'll gladly use CoStar and get value out of it.
And before I was in commercial real estate full time, one of my favorite places to look at deals was LoopNet.
Right.
So even though, and I did find properties there that I went and looked at, some of my first ones. So I think that's a great place to start if you're looking at buying a piece of property. And then as you kind of grow, it seems like CoStar has different offerings as you grow and as you get a bit more sophisticated.
Big time.
So really want to thank you for coming in, your insights. Having those insights alone on top of the hard data to look at can help us all make better investment choices as we go forward. So appreciate you coming in, and go Phoenix.
Yeah, absolutely. Appreciate it, and happy to be on. I'm glad you said what you said. That's ultimately what my group and CoStar's mission in general is about, bringing transparency to the commercial real estate market to help investors, owners, market participants make the most informed decision. And so happy to be a resource to anyone that's looking for more information. And thanks for having me on. This has been really enjoyable.